If you're looking for a mortgage where you don't have to have a job and you don't have to have traditional types of income, then you're in the right place. So, a lot of people don't realize that after the financial crisis in 2008, when a lot of people were doing what they call stated income loans, that's where, just like it sounds like, you didn't have to prove any income. You just wrote it down on the application. And as long as you had decent credit, basically you were okay. At that time, there were even stated income loans where you didn't have to put any money down. This is not quite that generous, but even though this is being recorded in January of 2024, it's possible today to get a mortgage and not list a job and not list any income. But of course, what you do have to have is a large down payment and very good credit. So I'm going to tell you during this video the basics of how this loan works and who it might be good for. So I've used this mortgage quite a few times over the last couple of years. And a type of person that this really works well for is somebody that obviously has a decent amount of money in the bank. So I had a gentleman about 2 years ago, and he had been what you would call a C-level executive. So I believe he had been a CFO of a company for a number of years. And he basically retired early and he started his own consulting firm. The problem is he had just started a consulting firm like that month. And for a self-employed person, you have to have at least 2 years of self-employment history to be able to get a mortgage. And even though we offer mortgages for people that are self-employed where they don't use tax returns and they use bank statements instead, you still have to have 2 years of history of being self-employed. So a mortgage like this, where literally on the application it is blank, there is no job listed, and it's blank, there is no income listed, it works perfectly because that's not even part of the equation. Now, you are going to have a minimum down payment of at least 20%. And you're going to also have to have a large amount of money left over after closing. And there's a guideline according to how much you put down, and as to how many what they call months of reserves you have to have after closing. So reserves, months of reserves, is just the mortgage payment. So whatever the new mortgage payment's going to be, you have to have with 20% down at least 18 months of that amount of the mortgage in either the bank or some sort of retirement fund, or basically some type of liquid asset or liquid account. A lot of times people say, well, does equity in my house work, or equity I have in car collection or what have you? That doesn't count. A liquid reserve or liquid account is something that can be sold basically immediately. So a retirement account would work even though there's going to be some sort of penalty. You can still access it if you really had to. Of course, cash, savings, stock, things like that, all that counts. If you put 20% down, a minimum of 20% down, you're going to have a very good credit score. So right now that's probably going to be 740 to 760. If you put more money down, then the credit score requirement goes down. So you can have down to a 700 credit score for this type mortgage. Some things that are really interesting about this mortgage is it's not just for a purchase. You can also take cash out, and the majority of the cash that you take out can be used for those reserves. If you decide that you want to do a cash out refinance, you would still have to have, I believe it's 3 months of mortgage payments in the bank, already when you did the mortgage. But then the rest, whether it was 12 or 18 months that you needed, could be made up of the cash that you're actually taking out of this mortgage. So I guess you're killing two birds with one stone. Another interesting thing about this is let's say that you just started a business, your family's helping you out. That 20% down can all be a gift. So you could get a gift from a family member, and that's fine. You could also, of course, get a gift for the reserves that you have to have after closing. And basically, those are that's how the loan works. Now, like I mentioned, it's not really for this video. If you would rather use bank statements instead of tax returns because you have that history, then we have programs for that too. Of course, the interest rate is going to be higher. Anytime you're doing a mortgage where you're using what they call a non-qualified mortgage, which this would be that, the interest rate is going to be higher. Typically, of course, the interest rate also, the less money you put down and lower your credit score, of course, the higher the rate. So on average, these types of loans are going to be probably 1.5% to 2% higher than whatever the standard mortgage rate is. So this is being recorded again in January of 2024. Let's just say the mortgage rate's about 7% now for a 30-year fixed conventional loan. So you're probably looking at a high 8% or even 9% rate for a loan like this. Of course, this may be the type of mortgage where you just get into the house, and then when you have that job history, we could do a refinance and put you into a normal mortgage, lower the interest rate. That's a strategy I use a lot as well. If you found this video helpful, I would love it if you click like and subscribe. If you have any questions, you can put them in the comments below. If you would like to talk to me about getting a mortgage like this, of course, that'd be great. You can go to my website, mortgagesbyscott.com, and feel free to call or text me at 704-890-7168.